All right, welcome everyone. Thanks for tuning in to this episode of the Hawaii Retirement Show. Today's episode, we're joined by Tracy Lownsberry, founder of Annuity Giants and owner of Up North Retirement. Tracy is an annuity-focused insurance professional and trainer who helps financial professionals better understand annuity products, strategies, and sales practices. Very excited to have him on. He is a plethora of knowledge when it comes to annuities, and I think this conversation will shed a lot of light on what annuities are, how they fit, how they work, and all sorts of other things. So, Tracy, thanks for joining us.
Thanks for having me. Excited to be here.
Great. All right, so let's jump in. Annuities come in all shapes and sizes. Uh, Depending, some people probably have never even heard of annuities. That's still out there for a large cohort of your average consumer. Or maybe they've heard of them vaguely. They don't really know what they are. Some people have really done their research. They're in the weeds with them. There's financial professionals out there who know a lot. There's also financial professionals that don't know very much or have misconceptions. So we'll just jump into what they are. We're not going to paint them as good, bad. We're just going to try to understand them and debate kind of where they fit in. So I guess to start things off at step one, first principles, what is an annuity? How should we think of it for somebody who's heard of it but doesn't really know what we're talking about?
That's a good question. The problem these days is that it's hard to define what an annuity is because there's so many different types and strategies. But essentially, to be an annuity, it has to be a contract where it offers some type of income for an extended period of time or for the rest of somebody's life. That is how it has to be classified as an annuity, as well as offered by an insurance company. So it's an insurance contract.
Gotcha. Yeah, and I always break it down this way, and I'd love to get your thoughts. Is and like you said, it's I'm sure the definition has changed so much from where annuities started to where they are now because they I mean there's so much more than just an income stream. But I always think about it as for those listeners, life insurance and annuities, they're both sold by insurance providers. So they are an insurance product. So what are we insuring? Life insurance is ensuring that if we pass away early, there's funds remaining for children, spouses, whatever it might be. Annuities, at first principles thinking, is insurance that we don't run out of money. It's longevity risk. That money keeps going. So it's kind of the yin and the yang, life insurance and annuities. Now, I know where we are today in the industry, that's much different, but what are your thoughts on just that simple, breakdown of it?
Absolutely. That's how I look at it as well. One is to insure you against living too long. The other one's insuring you against dying too soon, right? Annuities versus life insurance. So that's definitely the way to look at it whenever you're gonna pursue any type of education or potentially even go and purchase an annuity is keep it simple.
Yeah. Okay, so let's stick with that. So somebody wants to protect against longevity risk. So we're trying to manage risk. So when you purchase an annuity, and we'll get into, again, it gets much more complicated this, but let's just say an income annuity, um, you're transferring risk. And what you're transferring is longevity risk, but also you're transferring market risk, right? So can you touch on the transferring of risk there?
Sure. Yeah. Yeah. So essentially, there's a lot of people that think, well, if I'm gonna do an annuity, can't I just go do it myself? And the concept is actually pretty simple. So, insurance companies, they have risk pooling, right? This mortality pooling, where they have not just you, they have 1,000 or 2,000 or 10,000 or 100,000 other yous, and they know statistically how many of yous will live to average life expectancy or beyond. So they don't have to allocate all of their holdings for everybody to live to be 100 years old because they know that's not going to happen. So actually it's about 10%. So about 10% of their holdings are for people that are going to live way past life expectancy. So if it's just you and you're trying to insure yourself, well, now you have to allocate 100% of that chunk of money you're working with. And so that's the risk there, is that if you don't allocate all of that, or if you try to spread it around and you're still taking, a large income or a big chunk out, if you live long enough, you run out and you're done. See, if you live long enough, the insurance company just taps into the pool and essentially pays you. That's how they're able to do it so safely.
Yeah. And same thing works. I mean, same principle with car insurance. We all pay in, only some people need it, but the what is it? The law of large numbers, the averaging out
Right.
of everything. That's how it's able to work. And so a big theme with all of this that we talk about is there's trade-offs, right? Because
Right.
in exchange for me paying for insurance or for an annuity, I'm trading off something. Maybe that's upside, maybe that's whatever it might be, but in exchange for this contract, this safe thing. So there's always trade-offs, right?
Exactly. Yeah. Yeah. At the end of the day, you have to look at your money as having kind of two end goals. You're either going to spend it or you're going to give it away and somebody else is going to spend it. So if you think of it as, well, my goal for this portion of my portfolio or this chunk of assets is spending, then the trade-off is, risk. You're getting, you're lowering risk. The trade-off is also going to be things like growth potential in a lot of cases. If that money could have grown better elsewhere, the question is, maybe, but could it have sustained the income elsewhere? And that's where you're taking that whole risk off the table.
Yeah, totally. So again, this conversation here, the topic of the different types of annuities, even this could run probably a few hours long, and we still wouldn't get to everything that's involved there.
Right.
Um, but I'm trying to think of the best way to approach this. So I guess high level, right? We have our income annuities and variable annuities, and we
Sure.
have immediate annuities and deferred annuities. Um, can you just break down at the high level without going too deep into all the different kinds, but
Sure.
just what they are?
Yeah, so I like to break them into in immediate annuities and deferred annuities, and then kind of subcategories from there. So, an immediate annuity is just a contract where you're trading off a chunk of cash, whether it be qualified, non-qualified, Roth, doesn't matter. You're trading that for a stream of income that's going to start within the next year, right? So the goal there is you're kind of creating a pension plan for yourself, although it's not, if you hear somebody marketing it that way, you're not supposed to, but it's kind of very similar to it. Actually, a lot of modern pensions are actually annuity contracts. So it's an agreement between you and the insurance company where you're willing to make that trade, right? Now, deferred annuity is the exact same trade. Now you're just deferring it over a year. And because of that, you're building, or I should say you're getting closer to dying. Therefore, you're building mortality credits as you defer. And then they're willing to give you a higher paycheck because they likely won't have to give the paycheck for as long.
Mhm.
So those two broken down. But then from the deferred category, you also have a fixed annuity. And I would say the most common type is called a MIGA, or a multi-year guaranteed annuity. And these are pretty simple. They're pretty much like CDs, a couple different nuances to them, but essentially you want a fixed interest rate for a period of time and you can get that, 5% for 5 years, whatever it is, right? So it is essentially like a CD, just not offered through a bank. It's through an insurance company, and likely you can get extended periods of time, which can be a pro and a con. And you got to be careful. Then you run into the category of what I would say like hybrid or kind of accumulation annuities, where these are more designed on like a fixed indexed or registered indexed or variable chassis. And these are really more designed for accumulating your money. They do have things you can add to get lifetime income as well. And some of them do that very well. But essentially, it's you're willing to trade off and maybe trade off income or trade off liquidity or whatever to get some type of index growth or market growth, depending on which contract you go with. Which again, that's why we say not all annuities are for income either. Some are not actually designed that way. That would be those latter three there.
Gotcha. And where I fall on the spectrum, because we'll get into, there's all different advisors out there with all different opinions on these things. I love the like you said, the pension, Social Security, the income aspect of an annuity. I think is really good. Where I start to deviate, and I try to remain open-minded. I don't close it off and just say like some people, annuities bad, but I do think. And I kind of had a conversation about index universal life insurance with somebody about this too, how it becomes this Swiss Army knife where it can do a lot
Yeah.
of things. But the argument, at least the side that I lean on is, yes, it does a lot of things, but does it do any of those things really well? What
Right.
are your thoughts on that? And what I mean by that for listeners is like, let's say you have an accumulation annuity and there's some growth in there. My question would be, what is your goal? Is your goal growth? Is your goal transferring market risk? Is your goal income? Because if your goal is growth, then there's a lot of options out there that might be better suited for that.
Yes, absolutely. The hybridized approach, it ends up being kind of like the jack of all trades, which yeah, again can be okay, but it's likely kind of going to st and by the way, I'm not saying that the jack of all trades, those trades, handyman people are
Right.
bad. That's not necessarily the case here, right? But it's likely not going to be the expert in its craft. In each individual category because you can't, right? You're never going to see, an elite doctor who also happens to be a cop on the side, like it just
Right.
doesn't happen, right?
Yeah.
So think of it like that. If you can, we call it like intentional investing or intentional portfolio allocation. It's just, I want to assign dollars to complete this task. When you're trying to complete too many tasks, you end up with benefits that are, okay. An example, I'm not necessarily the biggest fan of a variable annuity, but it doesn't mean there's not good ones. But, you know, one that might not be the greatest would be one that, you know, has some investments in the market and they trail the market by, half of whatever the market's doing. So it's not a great performer.
Mhm.
And then it also has 3, 4, 5% of fees on it. So that's never fun. And maybe it has a lifetime income option too, but it's half of what other lifetime income options are. Maybe it has a death benefit option, but it's half of what life insurance gives you. See, so it has all these features, right? This level of safety, this level of market growth, this level of this level of that, but it's just not good at any of them. So you want to make sure that you're being intentional with which dollars you're assigning to complete whatever task you're looking to complete.
Absolutely. And while we're sticking on kind of the basics of these annuities, can we touch on there's going to be illustrations, prospectus, and there's going to be some terms out there that most people should be kind of familiar with. There's a lot of terms. We could go through, there's all kind of acronyms, but there's a few of them that stand out that you should know. And I think those would entail like uh, participation rate, right?
Sure.
Caps, spreads. So maybe you can shed a little light on um, what documents people can review and some of the key terms and what they mean and what they can look out for.
Yeah, for sure. I would say probably one of the most Um, we can call it misleading, I think. One of the most misleading things that a consumer is going to see likely when they're pursuing any type of annuity education is going to be a hypothetical illustration, right? Where essentially these companies put together an illustration showing you what they think you could do. And it's not necessarily going to be the guarantee. So every illustration has to come with a guarantee and a hypothetical. What we normally tell people is, listen, if the goal you have is not being covered by the guarantee and it's only being covered by the hypothetical, then the question you should ask is that hypothetical realistic, right? If somebody shows you a hypothetical and it's returning 3%, right? Okay, that's realistic. But if it's returning 12%, that means that for you to get where you want to be, you have to return 12% a year. I don't think I've ever even seen an annuity return 12% over it, maybe in 1 or 2 or 3 years, but never over a 10-year or gosh, a 30-year period. This is just never going to happen. So when the hypothetical and the guarantee are so far apart, that's when you red flags should start to go bing, 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 right? You want those to be a lot closer together so that you know that like worst case scenario, and then a probably going to happen scenario.
Mhm. So what about can you touch on the all right what you would value as you know 3 to 4, 3 to 5 key terms that people should be aware of
Sure.
like participation rate, obviously cap.
Yeah, yeah, yeah. Yeah. So this would be more associated with like an indexed product, which are mostly sold today. They're kind of the hot topic. And just a little baseline here of kind of how these are structured, where I'm going to give the sales pitch here, which isn't necessarily bad, just depending on if they're being, whoever is transparent here. But the sales pitch is, hey, the market goes down, this product will protect you. You have this zero floor. Okay. But if the market goes up, then you can index the market. I'm going to give some caveats here. There are a million different indexes today on the market. There are over 320 of them inside of indexed annuities. When you hear you can index the market on the way up, that only is true if you use a market-based index. And when there's so many different options, you just have to be careful. Sometimes the market's up 20% and some indexes are doing nothing, right? So just be careful. So the goal here is that I can have this zero floor. If the market goes up or my index goes up, I get to get interest credited. That interest credited comes in normally two specific forms. One is called a cap. And sometimes these are blended. Most of the time they're separated. But a cap is, hey, you're going to earn up to this percentage of interest if the index goes up. So as an example, cap is 5%. The market goes up 10%. You're indexing the market. You make 5%. You hit your cap. Market goes up 2%. Okay, then you're only going to make 2%. So it's up to whatever cap you're at. So that's one. The second thing is called a participation rate. This is always the confusing one because it's technically a percentage of a percentage. So again, let's say I have a participation rate of 50%. Market goes up 10, I get half of it. I'm at a 50% par, right? So you'll see indexes that have crazy participation rates on them. You always got to ask yourself, there's only 100 pennies in a dollar. So how can this company do this? If it sounds too good to be true, you should probably not do it, right? So those are the two. And then another thing I would say is something called a renewal rate. This is an important term for those of you who maybe you're pursuing a product that has a really good cap or a really good participation rate on an index you can understand. A lot of these contracts and these companies can change that. So you get in the contract, you're in it for 7 or 10 years. You know, you did it at a 10% cap. Great. That sounds awesome. And then year 2, you're at 9, and year 3, you're at 8, and then 7. And then they could bring you all the way down to the minimum. So that's called a renewal rate. It's what you renew at. And you got to be careful that if you're pursuing that type of a return profile, that if that company's going to hold the rate or not. So always look at those. So those would be your three big key terms.
So the renewal rate is when you're renewing the annuity contract, correct?
Yeah, each year. Yep.
Each year, right? So because it's kind of like for at least, and we're kind of focusing the conversation on the index, the variable
Yeah.
side of annuities here, but yeah, it's common for insurance providers to come out with new products. There's new names, right? It'd be like the Inspirational Defender
You got it.
6,
Yeah.
and they
That's
have these
good.
names, and and there's like different bells and whistles that come with this product, but I think it's important to hammer home. And I don't mean this as the insurance companies are trying to deceive. I don't mean that at all. It's perfectly fine. But there is a promotional rate type of thing in
Sure.
some of these products where what you're getting at the beginning won't be necessarily what you're getting at the end.
Yeah, and it really comes down to the product design, right? So as an example, if you're going to go into one of those types of annuities, if it's designed in the budgeted to be one designed for growth, then maybe they hold the rate for a lot longer than one that might be designed for income, right? If my goal is income and this company's going to guarantee me this big income check, they're probably not going to give me much growth. I always tell people you can pick two out of these three things. You can't really get all three. So there's three things your money can be, your money or do. Your money can be safe, your money can grow, and your money can be accessible. Pick two because you always are normally going to give up one. So if you want, safety and accessibility, you're probably going to give up growth. If you want, liquidity and growth, you're probably going to give up safety. So think of it like products. If you want one or two benefits, you have to give up a third.
Yeah, no, I love that. I love that framing there. That's useful. Okay, so let's talk about the advantages of these annuities. And again, we kind of led off where I really like annuities is for the income stream. And again, for those listening, maybe you have a pension, maybe you have Social Security. This is steady, secure income that you can count on in your retirement. You can have the peace of mind, barring that the insurance company is highly rated and they're going to continue on for forever, that this is just going to keep coming in. You don't need to be focused on watching, the market commentary on TV and what's happening. This is just going to come in, and that provides a lot of peace of mind. Now, that's an irreversible decision once you buy these annuities for income streams. But to me, I think buying an income stream, giving up the trade-off of growth when you have to decide, well, I'm not in a growth stage of my life anymore. I'm in retirement in decumulation phase, right? My focus isn't growth. So I'm okay giving that up because my focus is, simplifying things, having a steady income stream for me or my spouse. If one passes away, at least they know this will continue on or whatever it might be. So that to me is personally one of the best advantages of annuities.
Yeah.
Do you want to give a little bit more context around where they fit in, but the pros of annuity products, not just for the income stream?
Sure, yeah. Yeah, so the income side and kind of what it does is multifaceted, right? So, like you said, if my goal is that I want to turn an asset into an income stream, annuities are one of the top paying, I should say, options you can get for the level of safety that they bring, right? There's all sorts of options you can go with that aren't regulated or whatever, but we're talking, been around a long time with a good company, all that. So people tend to spend income. They don't really like to spend out of an asset, right? I got $1 million in ETFs. Which ones do I sell? I'm talking to my advisor all the time. Oh man, the market's down now. I don't really want to sell, so now I'm not going to spend. Well, the thing about that is that's fine if that's what you're looking for, and if your goal is necessarily growth, but then growth is never the end goal for anybody. Growth is just a vehicle to get you to your end goal because that vehicle is either going to get you to making sure you don't run out of money, which your end goal is really spending and longevity, or making sure you have a big pool left over for heirs. So again, what are you growing your money for? And sometimes you can kind of just skip the growth and the risk stage and just go right to that end goal. We see clients that say, "Well, okay, I get it. I really just want to make sure I don't run out of money." Okay, great. Let's like ensure that piece now, right? So the income side gives you kind of like the permission to spend your own money, which sometimes people need. It also gives the other side of your portfolio a lot of breathing room, right? If I can solve a big chunk of my income with this annuity, then now I don't have to take as much out of the rest of my portfolio or any. And now I can let it grow and compound and I can be more aggressive with it. And yeah, if the market goes through a tizzy, I'm okay because I'm not touching it, right? Maybe I'm even taking some excess income and funding a little bit more and buying at a discount. It just gives you so much more flexibility. And it also allows for flexible, dynamic spending as you get older with the rest of your portfolio as well. Like, man, I'm going to spend a lot now because I'm younger and healthier, but maybe I don't later. So I don't really have to touch the rest of my portfolio. This annuity is going to give me everything I could ever want. And it kind of self-adjusts for inflation in a way based on your spending habits. So there's a lot it can do outside of just an income stream. It's psychological, it's economical, it's mathematical, it's a lot of coals.
Sure. Yeah, and you know what I come to this a lot where I'm a big split the difference guy. And what I mean by that is when we're talking about oh, how much life insurance do I need? How much long-term care insurance should I get? How much should I put into this income annuity? It doesn't have to be an all or none decision. You don't have to go in swinging for the home run with all of your. I mean, I think there's actually rules and regulators won't let you put all of your nest egg
Exactly.
into these annuities, but you
Yep.
can kind of just get your toes wet, and you might buy a small annuity in your early 60s, and then maybe in your 70s you revisit and you buy another, income annuity. You can kind of layer these things, and it doesn't have to be an all or none decision, and nor should anybody, I think the bigger the impact of the decision, the more people should really take their time and make sure that this is what they want. Because, like I said, once that income stream turns on, it does become an irreversible decision.
Right. Yeah. Yeah. That's an important factor because it's not, if you go buy an ETF that you don't like, you can sell it and buy something different. You go buy stock you don't like, you can sell it and go buy something different. You go buy an annuity you don't like. Now there's penalties and waiting periods and, surrender charges to get out. Or, like you said, if you buy one that's, for lack of a better term, annuitized, it's you can't get out of it, right? So dipping your toe in with one that maybe has a shorter period you can get out of, and then determining, hey, maybe these things are right for me, or maybe psychologically you don't like that, and that's okay too, right?
Right.
It's all about what problem you're solving and who fits the bill.
Yeah, and I would say one advantage that's thrown out there that I've heard, personally, I worked in a firm for a short while that was very product heavy. I think they good intentions, but it was leading with products quite a bit. And and I know I've heard this many times that annuities, one advantage that's often pitched is you won't lose money. Um, and yes, and actually, I want to give that its due. Yes, I mean you won't. So if one of your goals is really you're just so risk averse and you just want to park the money somewhere for some sort of you just want to keep up with inflation, then there are these annuity products that can do that, even if you're not turning it into an income stream. What I would also say to that, though, is there's also other options outside of annuities that can also achieve that same goal.
Right. Yeah, I agree. There's bonds, there's CDs, there's treasuries, there's other options that have that kind of same level of safety if you use them the right way. It doesn't it's not the only safe vehicle out there. Money market, cash,
Right.
money in your sock drawer, it's like that's safe too.
Right. Okay, so we touched on some advantages. Let's look at some limitations or disadvantages. Um, we have there's the liquidity can be one. If it's a deferred annuity, then there are these surrender charges. We talked about if you're buying an income stream, it's irreversible, so there's that. But there's liquidity with surrender charges, um, and there's different rules around how much you can take out at different periods while it is in that deferral stage. So, if you just want to touch on maybe some limitations and disadvantages that you see out there that are kind of top of the list for people to be aware of.
Yeah, absolutely. Well, first off, on the two products that essentially you're trading off your lump sum for an income stream, which would be a immediate annuity and then a deferred income annuity. So the disadvantage there is yeah, it's a trade-off, right? So one thing that I think a lot of consumers might hear is if you die early, the insurance company keeps your money. That is only in something called a life-only annuity. And I don't see a lot of advisors recommending them, and I don't see a lot of consumers using them. The goal there is that essentially if you do life only, it's on your life only, therefore you should get a bigger paycheck. And I actually don't really see that. There's other options that have return of premium, which does give a death benefit if you die early, that have just as competitive income options. So that's what those two. With deferred annuities like fixed or fixed indexed or registered index linked or variable, or that's pretty much it. My guess. Those are going to have this surrender. Most of them are going to have this surrender period, right? So for the next 2 years, 3 years, 4 years, 5 years, they go all the way up to 18 years, which is insanity. Just I could probably say don't ever buy an 18-year annuity and be pretty comfortable with that one. Well, at least 18 year surrenderable annuity.
Right.
So that means that you're going to pay a penalty that will start out really high and then likely go down each year the longer you stay in it. So the penalty you only pay if you try to liquidate the contract. Now, they do allow what's called a free withdrawal provision, meaning if I go throw 100 grand into a 5 year annuity and I want to go access some of it, most of them allow you to access between 5 and 10%. So I would say most are 10. So if I want to go take out 10 grand or whatever it's accumulated to, I could do that without a penalty. And so obviously those are the limitations from a liquidity standpoint. A couple other limitations would be if you don't have any type of rider benefit, which is like an extra benefit they throw on there for terminal illness or exigent circumstances or whatever, then what happens is, oh man, I got this, I got diagnosed with this chronic illness, and I don't have a chronic illness rider on there, and I need $15,000 for treatment, but I can only access five. Then now all of a sudden you got to pay a penalty, right? So you can always add those little benefits. Sometimes they're not even a cost. Sometimes they are, but that is another limitation you got to watch out for.
Sure. Yeah, and that's you brought up one thing we didn't even touch on is, whether you buy the immediate income annuity, you're buying this income stream, or you buy this annuity as announced, something you're holding that'll turn into an income stream later. Similar to a pension, when most people are familiar who have pensions, when you go to initiate it, they're going to give you several options for how the distributions can be made. And you kind of touched on it there. It can be your just for you single life. There can be a survivor percentage benefit, and then there can be period certain. There's all these different ways you can approach the actual distribution aspect to at least provide some peace of mind. But again, we go back to trade-offs, right? For everything we do, there's a trade-off to it, right?
Yeah, and what do they say? There's 100 pennies in a dollar, right? These insurance companies aren't plucking money off the money tree. They're just assigning dollars to complete tasks like everybody else. So, if you want this benefit, it's going to require some pennies. If you want this benefit, it's going to require other pennies. One thing that I don't know if we're going to hit on this, but I'm going to hit on it now is the you might hear people say, "Oh, these products, insurance companies make a whole bunch of money, right, on your money." That's 100% not true. They just scale it, right? So the average insurance company profit margin is between 25 to 50 bips. So that's a quarter to a half a percent. So it's they just can do it and have a pretty successful company because they have billions and billions and billions of dollars under them. So to say that they're scraping up, 3, 4, 5, 6% off you. That's just not true. So I just want to hit on that since we're kind of in a little realm there of cost.
No, no, no. That's a great point, and that's a sentiment I've heard, amongst consumers or whoever it might be that, yeah, they're pulling one over on you. But yeah, and also like you said, I mean, to the other side, they're not in the business of giving you the greatest deal in the world for no. I mean, they're a company. They're just like any other business, just like the taco stand down the street. They're trying to make a profit. They're not in it for charitable reasons.
Exactly.
Yeah.
Yeah.
Okay, so let's talk about when annuities are poorly sold. Okay, so I think my opinion is this is very nuanced because I think there's a lot of advisors out there who are selling these poorly, but are genuine and have great intentions, but aren't
Sure.
aware of maybe some alternatives or some missteps that they're doing. There are some out there who are aware and are just trying to sell these things like used cars. Um, and then there's people out there who are closed-minded and they think this whole industry is a it's a scam to pull one over and never buy an annuity. These people are out here just, you know, and then there's people like you who are uh, somewhere in the middle where you're very well versed. You understand how they fit in. You understand that they're not innately good or bad. They are a product, a tool. And given the circumstances, they can fit perfectly into a peg for somebody's retirement plan. And it's just about understanding that. But let's start with what do you see in the biggest flaws in how these things are sold sometimes?
Yeah. Um, it's funny because I'm not funny. It's actually sad. I'm sitting on two cases I'm working on right now. One sitting on my desk here to my right, and another one gentleman coming in Friday, where they were sold annuities with this false premise. And then unfortunately with these two, it was actually to get them in the annuities, the advisor lied, which I never like to see. That's fraud, essentially. So where I would say the most common is just in this realm of ignorance, right? Where advisors don't actually understand that what they're offering isn't going to do what they kind of explain to the client. So we know what a guarantee is, right? If you're a client and you ask the advisor, what's the guarantee? Let me see it in writing. The guarantee is the guarantee, right? That's fairly black and white in most cases. That's not where people get hung up. It's on the non-guaranteed elements. And again, this would be on a fixed, indexed, registered index linked, or variable annuity. It's going to be on those three where this is now where the advisor is going to set this tone of this is what we are going to tell you we think this is going to do. And then here's some type of illustration that shows that maybe it did this or whatever. And as a consumer, it's hard. You don't really know what questions to ask. And sometimes it's a lot you need to ask. But I think that's probably the biggest thing that you got to be aware of is that misnomer, that expectation that was set, the bar was set so high And that's where people get in trouble is expecting that and then getting the result that was way, way different, right? If I'm using an annuity as part of my portfolio and I'm going to put a $500,000 in there and my goal is that in the next 5 years, I want to be able to start pulling out 100 grand. And because the illustration showed me I could, and it would last forever, and let's just say in this case, didn't have a guarantee on it. Um, Guess what? If it doesn't end up doing that, and your plan, this is part of your plan, well, now your plan just blew up. So now you have to do backtracking and triage and fix it. That's a big one. Is just that expectation. I think that's probably where the majority sits is on that performance expectation.
Yeah, but I would say too that these are complicated products. I think
Very.
it's a little unrealistic to expect to pull somebody in off the street, maybe, whatever occupation they have, but it's not in finance, right? It's something completely different. And now you're going to show them this presentation, explain all these things. It's just really difficult. And there is a lot of trust in whoever you're buying it from that they are shooting you straight and they are telling you everything you need to know. And I doubt, I mean, I'd be curious to know like how many people go into buying an annuity that walk away. And if you ask them after they come out of the office, uh, how certain do you feel you understand what you just purchased? Taking the bias away from, well, I did, so I have to act like I know. Like, how well do you
Right.
really understand? There's a disconnect there. And I think, whenever I come across an annuity, maybe a client has, or I see one, um, you know, I consider myself, I don't think I'm the end all be all. I'm not Michael Kitces out here, but I know what's going on. But even I approach things with a very much like, okay, hold on, let me figure out what this actually is because I know that there is a lot of variability there. I don't go in saying, well, I know what this is already. I could see it, boom, moving on. I have to take my time and take a look at it. And so there is that complexity makes it difficult. And then one last thing before I turn it back to you is the um the individual selling them. And I can make the same case for investment advisors or tax preparers. The bar or the barrier to entry to call yourself a financial advisor or to get 6 months of training and then start selling very complicated products. And I don't fault them. I mean, you got to learn, you got to take steps, you got to get into the industry. But it's and like I said, the same thing is true for taxes or being a financial advisor. Um, there's not much to get in and start wheeling and dealing these things. But yeah,
Yeah.
give me your thoughts on all that there.
Yeah, the barrier of entry is unfortunately low, especially on most of the insurance products that somebody can offer. Immediate, deferred, QLAC, which we didn't talk about, which is fine. Fixed indexed, all those can be offered after studying, 2 weeks for an insurance test and then taking it and passing it. And all of a sudden now you can go do a couple hours of continuing education and get licensed and sell the product. So yeah, the barrier of entry needs to be fixed. I'm not saying that we need more like governing bodies to change and rewrite it, but I do think it needs to be better. We don't necessarily need more oversight, just better oversight. And maybe a little bit more budget towards hiring some better oversight committees, but that's a whole different ball game. Um, but when it comes to the products themselves, yes, there's complexities that don't need to be there, right? And when you stick with like the simple, what is this designed to do? There are still going to be complexities on how it gets there, but it's all about the end result, right? So, if a client comes to me and says, Tracy, I want to fill this income gap, my what I would tell them is, well, are you okay with 0% return if I can guarantee you the lifetime of income? And now it's all about how many income checks you get for the rest of your life.
Mhm.
If they're okay with that, then it doesn't matter what vehicle I use as long as the end result guarantee is it's meeting that income goal, right? So whether that be an immediate annuity, a deferred annuity, an index annuity rider, a variable annuity rider, whichever one is going to give them that. So if you can stick to that like end result, let the advisor focus on the details to get you to the end result. Another one would be, hey, I want to maybe I don't need income, and I know we haven't talked about this. I just want something that buffers my growth a little bit, right? Like I don't want to take on a ton of market risk, but I still want to return. Maybe I call it gray zone money. Maybe I don't really know if I want to spend it later. So this is more of a period of time in which I don't really need a lot of it, and I just want to keep it safe and growing. Okay, maybe that's a MIGA, maybe that's an index annuity, whatever, with no bells and whistles. If the goal is I'm going to set this expectation, it's going to return between 4 and 7%, right? And we're going to use these indexes at this cap. It's pretty black and white, right? Or whatever. The simpler and more vanilla, the better the result normally. Because think of it as all those bells and whistles that might come in and all that complex design normally is followed by cost and in some way, shape, or form. Maybe not a fee, but maybe sometimes a behind the scene cost. And so yeah, keep it simple.
Yeah, perfect. And that's a good segue to one other thing I want to touch on is uh the compensation and cost of different products. Now again, we're kind of steering the conversation mostly to the deferred variable, indexed annuities. There's obviously just a there's a cost baked into even if you buy a single premium immediate annuity.
Yeah, for
There's
sure.
compensation and cost in there. But maybe you could shed some light on, I've heard, and I don't like this, is you don't pay me, the insurance provider does. And that's typically what the agent will say. And they're not
Right.
lying, they're correct. But then there's these baked in costs. So if you want to touch on um, how the agents selling these are compensated, and they should be, rightfully so. I'm not trying
Sure.
to belittle that. And then also, too, how to identify what these annuity products are costing in ongoing fees, M&E expenses,
Yep.
and such.
Yeah, so let's hit on the commission side first. So, some annuities are non-commissionable, where it's a fee-based annuity, where the advisor is actually it's very transparent. Here's the fee that I'm making off of your account value. Let's say it's 1%, right? It's very similar to like an asset under management fee, right? Those are rare, but they do exist. Most annuities are commissionable products, right? Meaning after the sale, the advisor gets a commission off it. The commission is a percentage that is kind of upfront. There are different ways you can take it. Most of the time, it's an upfront percentage. And then the advisor doesn't get paid after that at all, right? So the way to look at it is, let's say you go and you buy a guaranteed lifetime income annuity and it starts in the next 30 days. And you put in 100,000 bucks, okay? That advisor might make, let's say, 4 or 5% on it, right? So they make 4,000 or 5,000 bucks, but they don't make another dime on that product for as long as you have it, right? It's already baked into it because these insurance companies know how much profit they can make. They know their expenses. They know how much money on roughly they're going to make off of you. They know what they kind of have to pay the advisor, or else the advisor won't offer it. If we gave them 20 bips, listen, I don't know an advisor that would work for that. So it's got to be a good happy median. It's funny enough, little segue here. They actually studied non-commissionable products, which is direct to consumer, versus commissionable. And what they found was that most commissionable products offer better rates, which makes no sense. You would think, oh,
Oh,
if it's commissions coming out, how does that beat it? Well, because these direct to consumer companies, what they found was that nobody was telling the consumers about them. So they had to spend so much money on marketing that they spent more on marketing than they would have paid in commission. Funny enough. So if you're ever looking at a direct to consumer annuity, always compare it to a commissionable. You
that
might
is
find that,
interesting. That's a good
yeah, you
point. It's
might.
interesting. Yeah.
It is. I would not have thought it that way, but yeah, and it's not in every case, but in a lot of them it is. So yeah, there's a commission that gets paid out, and think of it again as that commission. Let's say that you go with a 10-year fixed annuity, and that fixed annuity is paying 5%. Okay. So that insurance company has to be able to make 5% to give you the 5% each year. And they can do that, but they got to make a little bit more than that so they can pay a commission and still have a profit. Most insurance companies' general accounts yield about 6.5, okay, at today's rates. So if they make 6.5, operations and expenses is, let's say, 1% and profits 1%. Maybe that advisor is getting that extra 0.5% over the 10-year and it's front loaded. Therefore, 5%. They're making that 5% commission. So I know that was a little bit of math there. Pause it, rewind it,
Right.
re-listen to it if you need to. But essentially that's it. It's baked into that way. And again, if that commission wasn't there, the question is, would you have a better product? In general, all things equal, Maybe it'd be very close. But there are products, and this is where you got to be really careful as a consumer. There are agents that will offer a product that does pay a bigger commission for less of a benefit. And you would never know unless you had somebody shopping the market and looking for you, right? I've seen it before. I've seen agents that offer these, whatever long surrender period products, and they get paid 2% more than one that was less and had better rates and better features and better this and better that. That's just, you just got to watch out for it. That's where you hope the agent or advisor is not doing it because they're just doing it for a commission and they just didn't know. But unfortunately, a lot of them try to game the system a bit, and they're willing to take away from their clients to get an extra few percent. So got to be careful.
Yeah, and I think that's an interesting question to ask if somebody is purchasing an annuity, because we just talked about all the different types of annuities, and then within those subsets, there's a bunch of types of each different one. To ask the agent or advisor selling you the annuity, why did you pick this one out of all of them, right? Because that
Right.
could spark an interesting conversation, at least to say, this is why I like that this insurance provider offers this product that does this, and this. But it's an interesting question to ask because of all the choices, why did you select this one and why does this one work best for me? I think that's a great
Yeah.
question.
It is, and even have it written down so then you can have it, to go back to if I don't know, you find out that it wasn't a very good product, right? Keep it in your records, and then maybe you can throw that back at them and say, hey, listen here, buddy, and we hate to see people get into products that aren't necessarily the greatest for them, but that does give you a little bit of insurance on the back end that if you did get taken advantage of in any way, shape, or form, that's kind of ammo you can use to work out, and a complaint and get out of an annuity and get into a better one as well without paying a bunch of penalties. It does happen. Insurance companies, they don't like that, people get taken advantage of. So you just want to make sure you document it all.
Sure. And I want to give credit where credit is due and I want to play both sides here.
Yeah,
You could vilify the commission-based financial advisor and make him out to be this guy who's just selling products that pay high commissions and he's taking advantage. On the flip side, there are fee-only advisors who are managing assets with uncapped AUM. And, you could make an argument that for what you're paying in that uncapped AUM, you know, could there be a taking advantage and this guy is just out to accumulate assets on that side of the spectrum as well? I think so, absolutely. Now,
agree.
I'm an optimistic guy, Tracy. I like to think most people are good. Most people are I mean, there's always going to be conflicts of interest, regardless of whether you're selling annuities, commission based, or you're fee only. I think most people are good, but there is these at both ends of the spectrum, these unfortunate, situations.
Agree. And those are also normally the loudest, right? So the most whoever's loudest gets the media and all that stuff. So no, I agree with you. I do think most people are trying to do the right thing.
Yeah. Okay, so this could be a whole topic in and of itself, taxes around annuities, but I guess the main point I want to hit on here is just kind of shed some light on when you're purchasing an annuity, any kind of annuity, you can purchase it with qualified money, qualified meaning, your Roth, your traditional, your 401k money, right? This is qualified tax preferenced retirement funds, right? Or you can purchase it with money right out of your checking account or from a brokerage account, which would be the non-qualified money. Um, the way these will be taxed depends on partially what money was used to fund it. Um, and then, yeah, I don't know how far I want to get on this because I mean, we can get into the exclusion ratio of payouts of how much is a return of basis versus this or that. But I just want to shed the light on you do want to do your research because the tax implications can be vastly different depending on what you're buying and what money you're using to buy it. And one last point is, again, going back to being intentional, like you got to think about if you're trying to be tax efficient, what is your goal, right? If your goal is an inheritance, does an annuity tax efficiently or from a growth perspective satisfy that better than maybe some other things? And again, I don't know how to stay high level on this without getting into the
Sure.
weeds, but what are your thoughts on all that?
Yeah, yeah. I mean, you can break it down, I think, pretty simple. So, like you said, so we have our pre-tax dollars, right? Which were tax preference when we were working. I'm in my highest earning income years, and I don't want to pay taxes on it now. So in retirement, I'll hopefully be in a lower tax bracket. That's the hope. Then you have your Roth account, which you pay taxes already, and then it grows tax free. And then you have your cash or brokerage account, or they call it taxable money, where I have this money that I already paid taxes on is cash, and then I invested it, and I have this basis. I invested 100 bucks, and now it's worth 200, and I just pay capital gains tax on the difference, which is lower. Well, most of the time you pay capital gains, but again, I'm trying to keep it high level.
Yes, right.
Yeah,
Fair.
which would be lower than like an ordinary income tax level normally. So in an annuity, you can fund it with any of those, but there is definitely a preference on what is most optimal, right? So if I have a Roth account and I know it's tax free and I know that it will always be tax free on the gains, I've seen people use it inside of an annuity, get tax free income, and I don't necessarily mind that if that's maybe all the money you have. But I really like growth in a Roth account, right? It's the last type of money you're ever going to spend. Normally, not always. So let that, if it's a long-term account, let that bad boy grow. And again, there is no rule that says this has to be for everybody because every situation is different. And I might do the exact opposite of what I'm about to say for a specific client. But normally, that's your growth money, right? Um, then you have your pre-tax qualified money, and your pre-tax money, that's where you got all these rules with it, right? Where you have to start taking it out at 73 or 75 now. For those of you who are older than that, you're already taking your RMD, right? That's where the government comes in and says, "Hey, I want my money.
Mhm.
Give it," and starts dipping their hand in at 3.77% and so on every year you get older. And so that creates this kind of issue of what if I don't want to take out of that account? Um, and then the government says I have to, and it's bumping up Medicare IRMA brackets, it's bumping up your tax brackets. It's not in your control. It's in the government's control. And as that grows, the government's is in the pocket and it's continuously growing. And that's the majority of what people see. Um, so that's always taxed at ordinary income, always. Never going to change, never will change, never has changed. So that's a pretty much a flat ordinary income tax bracket. You can't do anything to get around it other than Roth conversions. And then you have your taxable, which again, inside of an annuity is now a little bit different. See, if I had 100,000 in a stock and that 100,000 turned into 1 million over time and I die, my kids now get that stock at 1 million at that cost basis, and they don't have to pay taxes on any of those gains. In most cases, there are exceptions. If I had 100,000 in an annuity that was taxable, meaning I funded with cash, and it grew to $1 million, my kids have to pay taxes on $900,000 worth of gains. That is not preferential tax treatment, right? They would, and it's not capital gains either. It is ordinary income tax. So I think a lot of people use some deferred annuities and they'll put cash in thinking that it's a good idea. And in some cases it can be, but what you're doing is you're creating this tax deferral issue. Whereas as that continues to defer and defer, that's great now, but then you're creating this big tax burden later. So what I really like when it comes to an annuity is if you're going to need income and you have qualified money, spend down your qualified money first, right? In most cases, get rid of that stuff that the government has their hand in, always will have their hand in. Start spending that, enjoying it. And what's something that you can spend and enjoy and never have to worry about it running out? An income annuity, right? So we like qualified money in an income annuity, or pre-tax dollars. And that also gives all your taxable dollars and your Roth dollars, it gives them that I can now grow. It's a way better preference tax treatment on those. So you're essentially spending down tax preference dollars and you're growing tax preferential dollars. And that's kind of the design for most people. I think that works.
Mhm.
But again, catch-all canvas here,
Yeah.
not for everybody.
Right, right. And so I think the takeaway is okay, you've decided that whatever type of annuity you've decided on fits. Now ask yourself if you have different buckets of of, capital, brokerage assets, raw, traditional. Ask yourself, what money should I use to fund this? What are the pros and cons versus if I use this other money? Take that moment,
Exactly.
really understand the consequences there. One thing I wanted to ask you is, what advice do you have for somebody who purchased an annuity? Maybe it was 5 years ago, maybe it was 20 years ago, and they really don't understand it. What should they do? They're sitting on it, right? They have it. They know it's there. They get the statements. They give their accountant the whatever they need to give them. But what advice do you have for them for figuring it out?
Yeah, so I actually created and designed my own audit form. So what I would tell them is go talk to Jason. I'm going to share this audit form with him so he has it. And I would do an audit on it. And I'm sure you have your own too. So an audit, all it is hey, let's make sure that we collect all the data points we need to determine what it is and what it's not, and then you can understand it. That's first and foremost. And when you do that, what I do is I call the company directly. So if it's with New York Life or Pacific Life or whoever it is, I'm going to call them directly with the client and I'm going to fill out all of these key data points. And because then you're getting it directly from the horse's mouth. Again, I like to think that most people are good, but you may find some people fudge some of those numbers and make your annuity seem worse than it is unless you get it directly from the company. So you got to be careful. And then once you're able to do that audit, then just compare it to modern annuities. Interest rates were dead for a decade. Interest rates are now very high. Well, not actually, they're normal, to be honest.
Right.
Let's throw that out there. But they're higher than what we've seen in a long time. And when interest rates rise, annuities just offer better rates. It's just how it works. So you might find that a replacement of your annuity could yield a better result, but you'll never know that unless you do an audit. So do an audit. It helps you become more educated on what you have, which then in turns allows you to compare it to what else is out there. And who knows, maybe a replacement is necessary, not necessary, but an option for you to go buy a better rate, get a better income, get more growth, whatever it may be based on the annuity you have.
Yeah, no, that's great. And no, this has all been great, Tracy. I appreciate it. I think the I want to leave everybody with the idea that annuities are neither universally good or universally bad. You just got to lead with education first and understanding what you're getting into. Tracy, you have a ton of knowledge here. You shared a lot. Hopefully, listeners took a lot away from it. Our guest today is Tracy Lownsberry. Tracy, if anybody wants to find out more about you, is there anywhere they can look to?
Yeah, LinkedIn is normally where people can find me if you want to see my content or whatever. It's mostly advisor facing, but it's always good to see how advisors communicate with each other because essentially it's the end result is to help consumers. So yeah, LinkedIn's normally my main platform.
Great, Tracy, appreciate it.
Thank you, Jason.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by Toba Financial. For Jason Cutitta, investment advisory services are offered through Toba Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.